Good morning, everyone. Welcome to our 2020 year-end tax planning tips webinar. We hope to walk you through some key planning ideas, and especially in such an unprecedented year that we've had as 2020. So, my philosophy is to make lemonade out of lemons, and that's the goal here with our year-end tax planning tips. Most of you know me, but if you don't, my name is Marianella Collado. I am the CEO and co-owner of Tobias Financial Advisors. And I'll be moderating the presentation, but we will have our tax specialist, which I'll introduce shortly, speak on a few of the key topics. So just before we get started, we'll do some housekeeping. As you know, this is a general year-end tax planning presentation. Some of these ideas may or may not be applicable to you, and you should always either call us to make sure that you're implementing these strategies correctly, or make sure you speak with your CPA before moving forward with any of the recommendations. And also in terms of housekeeping, you will see that in your dashboard for the webinar, there is a section to submit questions. Please feel free to submit your questions. We will try to get to them as we're going through it, but we'll definitely try to leave time for a little Q&A at the end. So as I mentioned, my name is Marianella Collado, and I am the proud CEO of Tobias Financial Advisors. I, oftentimes like to wear my tax hat because I do have a passion for tax planning. So I say I'm a recovering CPA. But today we will have Flora Thomas, who is our in-house tax specialist, walk us through the key year-end tax planning opportunities. And what I hope to do as she goes through each of the main topics, we'll add a little bit of color on how we implement these strategies from a financial planning perspective. So I'd like to introduce Flora Thomas. If you want to give a little background on yourself, Flora, that would be fantastic.
Thank you very much, Nella. Good morning, everyone. Welcome to Tobias' annual tax planning webinar. Hope everyone had a great, wonderful Thanksgiving. Nella and I are very excited to present you our year-end tax planning tips. For those of you who may not know me, my name is Flora Thomas. I joined Tobias last November. I am a relatively new member to Tobias family. Before Tobias, I worked in public accounting firms, Ernst Young, and BAF together for 5 years as a tax accountant. Right before I joined Tobias, I worked for a publicly traded bank for 2 years as a senior tax accountant. I share the same passion as Nella, tax. One thing I'd like to share with you is that Tobias, as a wealth management firm, has a very strong culture and expertise in tax planning. We're not only ensuring the compliance side of various tax filings, but also proactively seeking opportunities for effective tax planning. Without further ado, let's get a party started. Here we go. You may ask, what is year-end tax planning? Simply put, the goal is to reduce your tax bills over multiple years and ensure alignment with your investment goals. Tax planning can be very complicated. As we all know, there could be significant change in tax rules, such as tax brackets, allowable deductions, and classifications of income and gains. In addition, tax compliance is not planning. And timing of strategy implementation is critical. Taxation of investment income and capital gains can be confusing. So as we all know, the capital gain tax rates are 0%, 15%, 20%, and can be up to 28% for collectibles. And on top of that, you may also be subject to net investment income of 3.8%, depending on your adjusted gross income level. With proper tax planning, we are trying to achieve the following 4 goals. Number 1, identify the ideal timing for income and gains recognition. Number 2, identify the ideal timing for the use of deductions, such as acceleration or deferral. Number 3, we want to assess the impact of income and deductions on marginal tax rates. And number 4, we want to leverage tax benefits to which you are entitled.
Excellent, Flora. Thank you so much. And that I love that you said that compliance is not planning. So, looking at a tax projection in January doesn't really help us move the needle. So really the key time is the next 4 weeks, right? This is critical timing to be able to take advantage of different opportunities. So we here as a team, I was speaking with someone earlier and I said it's like a tax zoo here. We're just trying to make sure we get through everyone's projections and making sure that we're working with their CPAs to make sure that we're implementing a lot of the strategies that are appropriate for our clients. So thank you, that was a really good comment.
Absolutely. So moving on, as you may also know, President-elect Biden's tax proposals in general would raise taxes on individuals with income above $400,000, including raising individual income tax, capital gain tax, and payroll taxes. Biden would also raise taxes on corporations by raising the corporate income tax rate and impose a corporate minimum book tax. So the table on the slide here illustrates some highlights on proposed individual tax changes. For the individual income tax rate, under the current tax provisions, the highest tax rate is 37%, which will be reverted to 39.6% after 2025. Under Biden's proposal, for taxpayers with over $400,000 taxable income, the tax rate will be 39.6%. In addition, under the proposals, long-term capital gains and qualified dividends will be taxed at ordinary income tax rate of 39.6% on income above $1 million. The proposal also eliminates step-up in basis for capital gains. The tax benefit of itemized deductions will be capped to 28% of value for people whose earnings are more than $400,000. That means these taxpayers would face limited itemized deductions. For example, if your marginal tax rate is 35%, under the current law, your itemized deduction would produce a 35% tax deduction. Under Biden's proposals, same amount of itemized deductions would be reduced to 28% tax deduction. So under Biden's proposal also would restore the PEAS limitation on itemized deductions for taxable incomes above $400,000. So you may ask, what is a PEAS limitation? This old tax provision was named after late Congressman Donald Pease. The limitation reduces the value of itemized deduction for high income taxpayers. It reduces itemized deduction by 3% for every dollar of taxable income above the certain threshold. That's not all for estate and gift tax taxes. The lifetime exemption amount will return to 2009 exemption level of $3.5 million, and the step-up in basis in inherited assets will be eliminated.
Excellent. Thank you, Flora. I think, the points you just raised here are excellent, because I think as we think through year-end tax planning for 2020, we do want to keep an eye on what are some of the tax provisions that are on the horizon that we should be thinking about in terms of 2020 planning. And, it doesn't mean that these proposed tax changes are going to go into effect immediately. In fact,
sure,
I believe that there's really going to be no change in any major tax legislation until probably the midterm election, because we didn't get a full blue sweep. So having said that, it doesn't mean we should ignore the fact that these things could be in the pipeline. In fact, we want to just have them on the back of our minds, because if there are things that we may want to consider accelerating or deferring, these are some of the reasons why we may want to accelerate some of the moves or defer some of the moves, just kind of having this in our back pocket as possibilities for a year or two from now.
Absolutely. Well said, Nella. Okay, so with the proposal, absolutely. Well, the proposal sounds a bit scary. Let's dive into our tax planning tips today, which are very good news. So number one, maximize 401k and IRA contributions. 401k and IRA contributions are generally pre-tax, which reduce your taxable income. Financial assets held under such accounts can grow tax deferred, whereas you pay no taxes until you take plan distributions. Especially for 401k plans, you can contribute at least to your company's match. While you're working hard and saving hard, be sure to take advantage of this free money. In the same time, if eligible, you can consider IRA or Roth IRA contributions for yourself or your children with earned income. For high earners, be aware of adjusted gross income limitations for deductible IRA or Roth IRA contributions. For example, for joint filers, you are not allowed to contribute to a Roth IRA if your modified adjusted gross income is over $206,000 for 2020. So the table on the right-hand side, I'm sorry, Nella, do you want to add something?
No, I'll chime in after just to make a point on the Roth IRA, because that's a key point, and oftentimes we catch mistakes because a client may have a Roth IRA that they just set up on their own and just think, oh, I can just contribute, but they're not aware of the fact that there are certain thresholds, so they can't really make that contribution, and the penalties are pretty hefty. Yes. So making a contribution, if you're not eligible to make one, could cause a 6% excise tax on those excess contributions. So that's key that you brought that up, because no one should really be funding any type of account without verifying with their CPA or their financial planner that they're eligible to do so. So that is a key point that you just brought up.
Absolutely. Yes, absolutely. Thank you. So the table on the right-hand side on the slides summarizes the contribution limits for different types of retirement plans and a comparison to 2019 limits. With the Secure Act that became effective on January 1st, 2020 this year, anyone with earned income can contribute to an IRA. Just want to clarify that pension, annuity distributions, investment income, Social Security benefits, rental income, they are not considered earned income. And also, don't forget the catch-up amount for people who are 50 and older. So Nella, I'll hand it back to you to add more color into a Roth conversion.
Yeah, I think the only point I also wanted to make is this: prior to the Secure Act, most folks who had already turned 70 and a half and were in required payout mode were not eligible to make a contribution to IRAs. They could have still done Roth IRAs, but not traditional IRAs if they had earned income. But there is one little caveat there, that if you're using the IRA to make qualified charitable distributions, you have to almost reduce the allowable contribution by the QCD or qualified charitable distribution. So again, just be careful. We're throwing a lot out there, but these are just almost like just food for thought, and just be very thoughtful before implementing any of these, because you may or may not be eligible. So this is key.
Okay, wonderful. Okay, so now we can go to our number 2 tip, Roth conversions. This is one of the Tobias' favorite and frequently used tax planning strategies. If you have a traditional IRA, you may want to consider a Roth conversion. Why should we consider that? There are many advantages of Roth conversion strategy. So I just want to summarize and provide you some very top level ones. The federal tax brackets are more favorable for married couples filing jointly than for single individuals. And the Roth IRA lets you lock in a current tax rate. Conversion reduces future required minimum distributions on traditional IRAs. Roth conversion turns tax-deferred future growth into tax-free future growth. Withdrawals from Roth IRAs do not factor into the 3.8% Medicare surcharge or net investment income tax or Social Security benefit taxation. There are no lifetime RMDs, which is required minimum distributions from Roth IRAs. Also, when it comes to Roth conversions, there's no income limits. The conversion amount in most cases is taxable, except when there's non-deductible basis in the traditional IRAs. You may also consider in-plan Roth conversions of vested and after-tax 401k, 403b, 457b plans. Just be aware that a conversion feature must be allowed by those plans. So extraordinary loss year or low-income years present a huge opportunity for Roth conversions. In Tobias, we review any IRA basis allowing for non-taxable conversions. So also I want to mention here is CARES Act and the Secure Act have provided Roth conversion opportunities as well. Nella, can you elaborate this for our listeners?
Sure, you knew I was itching to chime in, didn't you? So I do want to chime in because, you know, people are forgetting that there was a major change in tax rules at the end of 2019 because COVID hit and all of a sudden it was overshadowed. But I do want to bring a couple of points. Is part of CARES Act eliminated the need for those IRA owners to take a required minimum distribution. So what that means is that that may present an opportunity to, instead of having taxable income associated with an IRA distribution that you would have had to take, perhaps you can explore the idea of maybe doing some Roth conversions because now you haven't been thrown into that next tax bracket. So that's something that should be explored just because it's a unique opportunity associated with the CARES Act. And then the Secure Act did a major, I'm going to say, did a number on us. It really pulled the rug from a lot of the plans that we had put in place because ideally the situation is that you would have accumulated this huge IRA and it goes down to your children and they get to take distributions over their lifetimes. How smart, right? Well, the Secure Act changes a lot of the planning that we had originally done in that you are no longer allowed to, well, you could leave the IRA to your children, but they're no longer able to take distributions over their lifetime. They actually have a much shorter window to take those distributions. It has to be done within 10 years. It doesn't have to be done every year for 10 years. It could all be done on year 10. But in fact, you know, in light of these changes, you may want to consider some Roth conversions because instead of giving your children a bag of tax liability, you may want to consider buying out the IRS and removing that silent partner that you have in your IRA and in your 401k via Roth conversions. Now, I don't want people to blindly implement Roth conversions because there may be cases where it just doesn't make sense. But one of the things that we've been doing is kind of stepping back and taking a 30,000 foot view at what a Roth conversion opportunity means for our clients. And we're running these long-term projections to show the impact. So I think that's something that everyone should explore just to see if it makes sense. And then also just the last point here, just because we do love Roth conversions, is if you're not eligible to make a contribution or deduct your contribution to your IRA, it does present the opportunity for what's called the backdoor Roth contribution, which is another thing that we should talk through carefully because to me, that's huge. If you have 20 years of contributions to a Roth IRA, that could be a meaningful account growth in that Roth IRA.
Thank you, Nella. That's wonderful. So moving on to our number 3 tip, bunching of charitable giving and use the donor advised funds. Bunching accelerates charitable donations to allow for itemization versus taking standard deduction. One of the donor advised fund's biggest advantages is that you can get immediate tax deduction after transferring the donations to the funds, while the actual donations to specific charities can be determined later on over time. A donor advised fund is especially helpful where, for example, some people have an annual budget of, say, $5,000 to charities, and they don't mind bunching 5 years worth of donations, $25,000, but they haven't made up their minds where the extra $20,000 would go yet. By establishing a donor advised fund, it allows you to enjoy the tax deduction right away and also gives you time to make specific donations later as you wish. Under CARES Act, you can deduct your cash donations up to 100% of adjusted gross income for 2020. So this limitation used to be 60%. Nella, can you also give us some more details on donor advised fund? For example, how does it work? Why would it work better than just simply writing a check or donating securities directly to charitable donations organizations?
Right, and I think you touched on it, Flora, and it's that sometimes we want to be able to lock in 5 years worth of donations, but we don't want to give it all to the organization in 1 year. We want to be able to do it slowly because different things come up for these charitable organizations, and we do want to help our charitable friends because we know that COVID, if it affected all of us, it really affected a lot of nonprofits who basically all of their fundraising was put to a halt. But really the benefits of the donor advised fund, and we're independent, so we're going to go and use the platform that makes the most sense for our client. The one that we use today basically has a $10,000 minimum to establish the donor advised fund, and then for you to make the donations out or these grant requests, basically it's a $250 minimum. Very straightforward. We do like to pair them with appreciated securities, which I'm sure you're going to talk about why in a little bit. But basically, we take 5 or even 10 years worth of what you would give in the next 5 or 10 years and park it into this account. You have essentially parted ways with those assets, but you've also locked in the deduction. And this is key because if we know that in the pipeline is this idea of bringing back those itemized deduction limitations, it may significantly affect your ability to deduct charitable gifts in the future. So this may be a year for you to just front load them, get them all in there, and then slowly make those grant requests to those charitable organizations.
Great, that's wonderful. Thank you, Nella. So let's continue with our charitable donation topic. Let's take a look at what are the differences between cash donations and appreciated securities donation. So that is, we want to explain why donating securities directly to charities is better than selling the securities and donating the proceeds. By donating appreciated securities, you can save on capital gain tax and net investment income tax, and therefore maximizing the donated value of the securities. We have a simple illustration on the slide to show you why donating appreciating stocks is a better choice. So in a cash donation scenario, you can see on the picture to your left-hand side column, the green column, suppose you purchased stock for $20,000 and you sold it for $50,000 and you'd like to donate the proceeds to your favorable charitable organization. Here come taxes. For this stock sale transaction, you may have to pay 23.8% on the capital gain, which is $7,140 in this case. Then after tax cash donation is now only $40,860. Assuming the marginal tax rate is 37%, the tax deduction is $15,858. Your net savings on the taxes is only $8,782. So we use $15,850 minus $7,140. So that gives you the net tax savings. So on the other hand, if you donate the stock directly to your favorite charitable organization, one, you're not paying the capital gain tax or the net investment income tax of the $7,140. Two, the value received by the charitable organizations will be the full $50,000. So assuming the same marginal tax rate, 37%, the tax deduction is now $18,500, and your net tax saving is $18,500. While the math sounds good in a stock donation scenario, you may run into the situation where some charities may not be able to accept a stock directly. So in that case, we highly recommend and suggest donor advised fund, which will be able to hold your stock until you write a check.
Yeah, and I'd like to also give a different perspective on an opportunity here. Is I tell clients that this is an opportunity for a free step up in basis. Because if you bought Facebook years ago, for example, it's appreciated significantly and you just love Facebook, you just want to keep it forever. We still encourage you to donate those highly appreciated Facebook shares, and you could just rebuy them with the cash you would have otherwise donated. So in essence, you just gave yourself a free step up in basis because you're in the same place. You just donated or got rid of the capital gains.
Absolutely. Yeah, that's well put. So moving on, let's look at our next tip. Tip number 5, gain or loss harvesting. So this is another our favorite tax planning tools, which we use often to help clients lower their capital gain tax and a net investment income tax. This is how we normally do it. We review realized and unrealized capital gains and losses before year end. We also confirm the capital loss carryovers. If there are large amount of realized capital gains, we will harvest losses to reduce the capital gain, therefore reducing the capital gain tax and the net investment income tax. It is a bit more complicated and more to consider when it comes to the gain harvesting strategy. In general, if a taxpayer is in a high tax bracket for the previous tax years and future tax years, say 35%, but perhaps 2020 is a special year when this person has very little income. And now his or her tax bracket is 0% or 10%. This is where we consider harvesting gains so that a gain will be completely tax-free. But Nella, in context of loss harvesting, what are the wash sale rules? How does that affect, say, loss harvesting strategy?
Yeah, and that's a good point because you might think, well, I'm just going to go ahead and take all the losses I can find. But you want to be careful because you don't want the tax tail to wag the dog, right? You don't want to put yourself in a situation where you're economically worse off by triggering a tax loss. And what do I mean by that is the idea of always staying invested, right? You don't want to trigger the loss and just sit with cash and all of a sudden the market has skyrocketed, and we've seen how volatile the market has been lately. So we would never recommend that someone just trigger a loss and just sit with the cash on the sidelines, because if you took the loss, that same sector in the market or that asset class can immediately turn around and that value could exceed the loss that you just tried taking. So you have to be very smart about how you harvest losses. And you basically, if you sell a security, you can't buy it right back, right? So that's what I mean by being economically worse off. You still want to be invested, but you can't just sell Facebook and buy Facebook the very next day. And Facebook is probably a really bad example, but you can't just sell the security, take the loss, and buy it right back the next day because you think it's going to go up in value soon. That would trigger what's called the wash sale rules. So the way we typically implement this strategy is that if we sell a particular fund, we have to make sure that when we reinvest, we're not investing in something that is what the code refers to as substantially similar, because that would trigger the wash sale rules. And that basically means that the loss wouldn't be allowed. It's all disallowed when you get your 1099 from your brokerage firm, you're going to see that they have a little W that says wash sale rule, and the loss is zeroed out. So you have to be careful how you implement that.
Thank you, Nala. That's well explained. Also, I have another question. So in light of Biden's tax proposals, it seems capital gain tax will no longer be preferential rates if the income is $1 million or more. So many of clients or many people would ask whether it is necessary to harvest capital gains as much as possible into 2020 to avoid down the road 39.6%. What do you think?
Yeah, I mean, I would say that only special circumstances. I am of the opinion that I wouldn't go crazy triggering all the gains in your portfolio just because you anticipate that the capital gains rate will go up to 39%. Because if you have someone who's actually paying attention and manning and watching the house, they can do these loss harvesting strategies on an annual basis. So I wouldn't just start willy-nilly triggering gains, because you can plan around that, is number one. The other thing is that where I may consider accelerating gains is if you have a business owner who is already planning on selling the business. It may take a while for you to do all the due diligence and get the deal closed. So in that case, maybe you want to push to get the deal closed, if not this year, maybe too late, but next year. That would be the only time I would consider accelerating a gain in anticipation of a change in the tax rates going forward.
Wonderful. So I have another question. So we know another investment vehicle appeared right after TCJA a couple years ago, Opportunity Zone Investment. Nella, can you tell us a bit more about that?
Yeah, and again, this is why I wouldn't be so quick to just start triggering all the gains in your portfolio, because there are other strategies to mitigate or defer capital gains, and qualified opportunity zone investments are one of them. So this is where if you take all your gain from the sale of, a security or a business, it doesn't have to, unlike a 1031, it doesn't have to be specific to real estate. Any gain, and if you reinvest in a qualified opportunity zone fund, basically the gain gets deferred for 10 years. After 7, you get like a 15% reduction. 15% of the gain is just completely wiped out. And then you do have to recognize that gain after 10 years on the original sale. But if you do hold that investment for at least 10 years, the appreciation from the new investment is also completely tax-free. So this is something you can explore if the opportunity presents itself. So again, another reason not to go crazy triggering gains in your portfolio, because we can plan around it. We're smart like that, Flora.
Absolutely. Yes, wonderful. Okay, so let's get into our next tip, number 6, house savings account. A health savings account can help people with high deductible health plans to cover their out-of-pocket costs. Contributions to HSAs generally are not subject to federal income tax, and earnings in an account grow tax-free. Unspent money in an HSA rolls over at the end of the year, so it is available for future health costs. Some employer HSA plans offer extra benefits, which is great. However, there's no need for employers to offer an HSA plan. You can open one on your own as long as you are eligible. Generally, a high deductible health plan requires minimum annual deductible of $1,400 for a single plan and $2,800 for a family plan. That's for the 2021. This must be an HSA eligible plan. So another unique feature of an HSA is that you're allowed a one-time IRA rollover to fund the plan. For 2021, the maximum allowable contribution to is $3,600 for single plans and $7,200 for family plans. An additional $1,000 catch-up for people who are 55 or older. For married couples who are both over 55 and who have a high deductible health plan with family coverage, to be able to maximize their combined HSA contributions, which is $9,200 in total, $7,200 per family plan, and $1,000 catch up for each spouse. So a separate HSA must be established to be able to take this 1,000 catch up amount. So Nella, you think of anything you want to add here?
This is great. I'm going to just mention a couple of things that have come up when people are exploring their ability to fund a health savings account. Just because you have a high deductible may not necessarily mean that that health insurance plan is an HSA eligible plan. A key hint that it is not eligible is if you have copays. So that's a major hint. But I would also just confirm with your health insurance provider that the plan you have is HSA eligible. And then the only other point I'm going to make that is that this is all well and good that we're funding these. These are, you get the deduction on the way in, it's tax-free on the way out. This is great, but you have to invest it. So the idea is that while it's sitting there, you try to invest this. And usually what we like to do, and we'll talk about this a little bit later, is that what you do in the HSA is that you invest it in whatever asset class you expect will have the most growth, because that's how you're going to get the most value out of it. So in a perfect world, you would fund it and not use it currently, but do track all of your medical expenses so that 20 or 30 years from now, you would have accumulated a whole box of receipts that you can apply to those distributions in 20 and 30 years so that they're tax-free.
Wonderful. Okay, so our next tax tip is withholding planning for bonuses and IRA distributions. In Tobias, we review your year-to-date withholdings and expected tax payment, and we assess whether estimated tax payment is needed. To avoid a possible large amount of tax due at the time of filing and underpayment penalties, we normally recommend clients consider adjusting withholdings on their bonuses or other late-in-year income. Furthermore, we want to be sure you consider fringe or similar benefits not captured on a W-2, which may trigger additional tax, for example, dependent care benefits. Okay, so next one, Nella, do you have any comments on the withholding planning? Okay. All right, so let's move on to our next tip. This one we want to talk about is qualified charitable distributions, also known as QCD. So the major benefit of using QCD is that 100% of the charitable contributions, regardless whether you itemize or not, is tax deductible. This is especially important since many people will now not be able to exceed the standard deduction of approximately $12,000 for single filers and $24,000 for joint filers. There are some other advantages of making QCDs. First off, it is above the line deduction, allows you to reduce your taxable income, which otherwise would be required minimum distributions and included in your adjusted gross income. So in the context of itemized deductions, adjusted gross income will be used to assess whether or not and how much of the out-of-pocket medical expenses can be deducted. Furthermore, the modified AGI affects your Medicare premiums. Medicare premiums are assessed based on your modified adjusted gross income reported 2 years ago. For example, for single filers, if your 2019 MAGI is below $88,000, you are paying the lowest premium for 2021. For joint filers, if your 2019 MAGI is below $176,000, you will pay the lowest Medicare premiums for 2021. So for this purposes, modified adjusted gross income refers to your adjusted gross income plus the tax-exempt interest income. CARES Act, yes, Nella, you.
No, I was going to say excellent point.
Okay, so also we want to mention here is CARES Act also allows for a $300 cash donation deduction above the line for taxpayers who are not able to itemize for tax year 2020.
Yeah, so I'll just add a couple of points. So only taxpayers who are 70 and a half are eligible to do qualified charitable distributions, even though the Secure Act changed the required minimum age to 72. For purposes of qualified charitable distributions, it's still the 70 and a half.
Yes.
And so the other cool thing that we've been able to do for our clients, for those who do make charitable donations but may not make enough to get them over the standard deduction, is we set up like an IRA checking, so they can do their $10, $18 donations straight from the IRA, and this way they are ensuring or guaranteeing that they're getting a deduction, because that payment is not taxable. And the only other warning is for our CPA friends, right? They know that when they get the 1099s, the 1099s from any brokerage house doesn't identify that some of those distributions were actually qualified charitable distributions. So you always have to make sure that you tell your CPA, hey, $200 of the total amount I took from my IRA went straight to charity, because they're not going to be able to know that just
Absolutely.
from the 1099.
Yeah, absolutely. That's a wonderful point. Yes. So moving on, our next tip is to utilize solo 401k, SEP IRA, or simple IRAs if self-employed or have other consulting type of income. So what are these type of accounts? An individual solo 401k is for owner-only business with no employees. It has all the benefits of a traditional 401k, namely high contribution limits and very easy to administer. A SEP IRA is designed for owner-only business or businesses with just a few employees. There's no filing requirement with IRS. It allows contribution for owners and any employees, and it is also easy to administer. A simple IRA is for businesses with up to 100 employees. It is primarily funded with employee salary deferral contributions. Employer match contributions is up to 3%, and it's also very easy and economical to administer. So Nala, share with us your insight on all these types of solo 401k or SEP IRA or simple IRA plans.
Yeah, so when you're self-employed, you have consulting income, my eyes open up. You might see a twinkle, because it really presents planning opportunity. So another way to just kind of take this to the next level, and I say put these retirement plans on steroids, is you can even look at, setting up what's called a defined benefit plan. So I joke that if you have consulting income and you kind of just, the stars are aligned in such a way, you might be able to pretty much shelter all of that income and not pay any tax on it with a defined benefit plan. So these are really powerful retirement savings strategies. And to me, they're a tax play. So it's like you guys hear me say all the time, you're just moving money from your left pocket to your right pocket, and then voila, a tax deduction. So definitely something to consider for business owners or self-employed individuals who have consulting income.
Right. So the defined benefit plan sounds really good. Are they expensive to set up, or are they easy to administer?
No, so we will go out to market and get quotes from different third-party administrators who are the experts needed to do all like the actuarial calculations to determine how much you're able to put in there. And they might charge like maybe $1,500 to set up and maybe another $1,500 to do the annual administration. But if you're able to contribute $100,000 and you have a $40,000 tax deduction, then that cost is just negligible. It wouldn't be a deal breaker to set these up because they're so powerful.
Yeah, that is so true. Okay, so for our next tip, I'll turn over to Nella to share with everybody the annual exclusion gifts.
Yeah, so this, and I know everyone, it's all over, the news, if they reduce the estate tax exemptions, you need to act now because you won't be able to shelter this much wealth and pass it to the next generation. So let's talk about that a little bit. Today, each and every one of us has an $11,580,000 estate tax exemption, which means we can give this away either during our life or leave it as an inheritance for our children. And so if you have less than that in total net worth, you don't need to worry about it today, right? Because you're not expected to be in an estate taxable situation. If your total assets exceed the 11,580,000, then you need to think about ways to start moving some of that wealth to the next generation. And with the Biden proposal, there are talks of reducing that to possibly 3.5 million. So that's huge. So definitely this should be on the back of your minds, and you should be talking to us or your accountant or your financial planner on what are some of the things you need to be thinking about today. I'm not, depending on what your financial house looks like, I'm not going to recommend that we just give it all away, because obviously we have to make sure that you still have access to that and you're able to meet all of your needs during your lifetime. So we want to be cautious that, yes, we want to plan for estate tax purposes, but not to the detriment of your own financial well-being. So some of the things that I do encourage is making annual exclusion gifts. Each of us can give away $15,000 a year to our children, their spouses, grandchildren. So definitely taking advantage of the annual exclusion. That's the amount that you can give away without chipping away at the 11 million. If your taxable estate does exceed the 11 million, you could be facing a 40% tax. So that's huge. So I like to remind people that you can always pay for your children's education directly, as long as you pay the institution. That doesn't count as a gift. Same with medical. If you're paying for someone's health care, if you pay the doctors and hospitals directly, that doesn't count as an annual exclusion gift or a taxable gift. Another strategy that we're looking at for most of our clients, if it makes sense, is front loading gifts to 529 plans, because 529 plans present a unique opportunity where you're shifting wealth out of your taxable estate. But if you need it, you can still pull it back because you're still the owner of the account, not for estate tax purposes, but if, in reality, you are still the owner, so you can pull it back. We're also looking at making sure that for those who are projected to have a taxable estate, that we look at who owns their life insurance policies. Do they need to be moved into irrevocable trust? Because that's the only way that those death benefits will be excluded from your taxable estate. You often hear people say, well, life insurance is not taxable. Yeah, it's not taxable to the recipient, but if it's in your name, you own that policy, it will be includable in the calculation of your taxable estate. So there's some very big topics here. Definitely, if you find yourself in this situation, we need to be proactive about what we're doing today.
Absolutely. Okay, so let's talk about a little bit about the stock options. We'd like you to be aware that the stock options impact on tax. We all know exercising incentive stock options creates alternative minimum tax adjustment that would potentially increase your exposure to AMT. So we need to consider avoiding exercising ISOs if you are or close to being subject to alternative minimum tax, or exercise only the amount that will result in no AMT liability. Employers are not required to withhold taxes when you exercise an ISO. So it is your responsibility to ensure proper reporting of alternative minimum tax. So usually we recommend wait 2 years from the grant date and then more than 1 year from the exercising the options. So this over 3-year period would generally result in a favorable long-term capital gain treatment on ISO sales. Also, I want to mention here is the presidential election result may affect the future tax rate significantly. So Nella, what should we do about this?
Yeah, so this is critical because if you're, if you find yourself in a situation where you could be subject to a much higher income tax rate in the future, or in with regards to ISOs, incentive stock options, the capital gains rate are projected to be 40% in the future. You may want to think about just accelerating them and triggering that ordinary income pickup now. This is really complex. So what I recommend is that if you do have options, that you make sure you have a schedule and you sit with us to kind of go through them and help you time when you should exercise, when you should trigger the ordinary income pickup. So, that it has to be a lot more thoughtful than, just here, do this year, do this that year. You have to kind of look at it, looking at a couple of years side by side to see what makes sense. So with this, definitely this requires an analysis and for us to sit together to think about what makes the most sense.
Right, absolutely. Okay, so next we like to talk about is passive activity loss rules. So in general, passive losses are only deductible against the passive income. Rental properties by default are passive activities. So if you don't have any passive income, those losses get carried into future years, and such losses expire with the taxpayers. So to release these losses, you generally need either passive income, or you can dispose of the investment to realize the losses in that year. And public traded partnership losses are only allowed against that specific PPP's income. So our next tip, Nella will take over to talk about, this very last tax planning tip for today, tax effective investing and tax diversification.
Yeah, I think the main theme here is that, how you invest in terms of tax efficient, like what does that mean? What is tax efficient investing? And that's critical because if you have a portfolio that appears to have a 10% rate of return, but it's inefficient, meaning that you're triggering a lot of short-term capital gains, the income that's being passed off is in a taxable account versus a tax deferred account, that rate of return is not really 10%. It's more like 5% because it gets sliced in half after taxes. So here, because we're very tax conscious, we're very careful about how we're investing, meaning that in taxable accounts, we want to make sure that we hold investments that pass through qualified dividends, long-term capital gains. Even when we have to rebalance, we're careful that we don't rebalance and trigger short-term capital gains unnecessarily. We may just need to wait a week or so. So that's what tax efficient investing is about. And even if you think about your corporate bonds, right, where it pays ordinary interest income, where do you want that income? Do you want it in a taxable account or a tax deferred account? So the idea is that you're being very thoughtful about how you're investing. What assets are you holding in your 401k or your IRA or your Roth IRA versus your taxable account? Because that is going to determine the tax efficiency of your portfolio. It's not just asset diversification, but you have to think about asset location. And that's going to be critical because long term, that's going to make a big difference on the growth of your wealth. So that's all the point that I wanted to make on there. And that I didn't realize we were having so much fun, and we have about 6 minutes to the hour. So what questions do people have? I see one question came in with regards to the health savings account. The question is, at 65, can I use the money in the HSA for only health? So a health savings account at 65 almost turns into like an IRA. You can use it for anything. In fact, you can use it for anything at any point. But the idea is that you're keeping receipts so that when you do take distributions from the health savings account, they're tax-free. So again, going back to the point is I'm a big fan of just funding the maximum, investing it, maybe putting it in, you know, small cap, emerging markets, something that's going to explode in value, because that's how you're going to get the biggest bang for your buck. And then later on, when you take a distribution, you have sufficient receipts to basically make that distribution tax-free. So that's the only question I see here so far. We'll give everyone a couple of minutes to see if they want to submit any other questions. Otherwise, you know, you can always reach out to us. Let me see if we have our contact information here. We don't. But you can always reach out to us, send us an email, give us a call. We'd be happy to walk you through any questions you have. And if you haven't heard from us yet on your tax plan, is because we're still working on them. And as soon as we've wrapped them up, we will be calling everyone with any moves we need to make by December 31st. Laura, did you want to add any other closing comments?
Oh, no. So we're good. I think we gave our audience another 5 minutes if they have any questions.
Yeah, we can close up, and if you guys have any questions, you know how to reach me. I see a couple of friends here sending me messages on my phone, so I'll respond to you. Thank you all for spending this hour with us. We hope that you took away a nugget or two, and we look forward to speaking with each and every one of you before the end of the year. Have an amazing holiday and Happy New Year, and we are all looking forward to a new year, COVID-free.
Absolutely.
Everyone have a blessed day and be safe.
Yeah, thank you all. Bye.
Take care. Bye-bye.